Okay, now we're recording. Let's see. We are going to be continuing in chapter 26 on GDP. So much of what we will be talking about in that macroeconomics has to do with GDP because we're interested in how is the overall economy doing, how's it performing. And obviously the US economy is just incredibly complicated and complex, and it's not hold on. It's not reasonable to think there's going to be any single number that's going to capture everything that's going on. But GDP is the best single number we have for assessing what's going on. And so we need to understand how it's calculated, what's included, what's not included. And we also need to understand its shortcomings. And by the end of class today, we should be able to talk about its deficiencies, because GDP definitely does not take into account everything that affects our well-being. What we are ultimately concerned with is well-being. Are things getting better? Are things getting worse? GDP is the best indicator we have of that, but it is definitely not perfect. We will see that there are things that make us worse off, but which may actually increase GDP. We'll talk about one thing we'll talk about later today is natural disasters like hurricanes. It is possible that if the hurricane hits and does a lot of damage, it is possible that that could lead to an increase in GDP. It might not, but it might. And we should definitely not jump to the conclusion, well, if the hurricane increases GDP, then it was actually a good thing. No, your intuition is correct on this. A hurricane is not a good thing. It doesn't make us better off, but because GDP is an imperfect measure of our well-being, it is possible that it can cause GDP to go up. So we'll talk about that later today. Let me share. All right, you should be seeing the PowerPoint screen.
Yeah.
Got it. Okay. Just to remind you of what we said last time, very important that you understand that and that you remember what GDP is. It's the total market value of all final goods and services produced annually within a country's borders. That's a definition. You need to remember all of it. You need to be comfortable with it and understand why each part of that is important. We said that not all transactions are included in GDP. We said you sell a used car, sell a used house, sell anything that was produced in a previous year, then it will not be included in GDP. We said purely financial transactions. You buy shares of stock, you buy bonds issued by a corporation or by a government. You invest in certificates of deposit. Those are all useful things to do, but we do not include them when we're calculating GDP because the amount of that transaction does not represent the value of something that was produced. We did say that when you sell a house, for example, and there's a commission paid, that the value of the commission would be included because it represents the value of the service the real estate agent provided, and that service was provided in the current year. So you always go back to, does this, in this transaction, does it represent the value of something that was produced this year? And then third, government transfer payments. We said those are not included when calculating GDP. if someone is getting unemployment payments, they're getting Social Security check, they're getting some type of low income assistance payment. We're not saying there's anything wrong with any of those, but we're saying there's no production there. They do not represent, or Social Security, for example, does not represent the value of something that was produced by the retired person. And so we do not include that in calculating GDP. Now let's move on. We said there, well, I may not have said last time, but there are two approaches to calculating GDP. And this is really important to understand. This will kind of structure your thinking from here on about GDP. One approach is called the national spending approach. Sometimes it's called the expenditure approach to calculating GDP. And before we get into the details of it, just intuitively understand what it is. With the expenditure approach, we're looking at how much people spent. And we're saying, how much spending would it take to purchase everything, every final good and service produced during the year? How much total spending would it take? So think about, for the year, all the cars that were produced, all the new houses, all the computers, the food, the clothing, all of that. Just imagine it piled up somewhere. The spending approach is answering the question of how much would have to be spent to purchase all of that output. And the expenditure approach can be summarized very concisely with this one equation. Y equals C plus I plus G plus NX. NX stands for net exports, which is the difference between exports and imports. Now here we're introducing a bunch of new terms. And in this chapter, we will be including a bunch of new terms, but they're important, and they kind of provide the structure for what we're going to be doing in the future. So most of the chapters we cover won't add so many new terms, but this is one that does. And it's going to take us a little while to explain what this equation means, but you just want to remember it is a very concise summary of the expenditure approach or spending approach. When you hear spending approach, this is the equation that you want to come to mind. Y is just the symbol that we will use for GDP. And remember, what is GDP? It's national output. It's our measure of how much was produced during the year. Why do we use Y to represent GDP? Well, we use it because of something was done back in the 1930s. You may have heard of Keynesian economics. Keynesian economics. Any politician you hear who's saying that government, to deal with our current economic situation, government needs to spend lots more money to help the economy. That's really a very Keynesian idea. And so I'll just spend a minute on that. Keynesian refers to an economist named Keynes, John Maynard Keynes. And in 1936, excuse me, in 1936, he wrote an extremely influential book that really revolutionized macroeconomics. We'll go into that more in later on, but the reason, I only bring it up now because the reason we use Y to represent GDP is because when Keynes wrote his famous book, The General Theory, in 1936, that's what he used. So, we could use anything for it, but traditionally that is the symbol that has been used. To think about what this equation is telling you, think about it like this. We are with the spending approach, we're trying to calculate how much spending it would take in order to purchase all of the output that was produced during the year. So you think of this equation as dividing the economy into four sectors. The household sector, the business sector, the government sector, and the foreign sector. And roughly, C represents spending by the household sector. C stands for consumption spending, but it roughly represents spending by the household sector. I represents investments, which is primarily spending by the business sector. G, you could probably guess, represents government, but it's not government spending, it's government purchases of goods and services. We'll go into the difference between spending and purchasing in just a moment. And then the last component here, which is generally, we just write that as NX, stands for net exports, which is exports minus imports. Okay, that's our first approach to calculating GDP. Our second approach is called the factor income approach, or sometimes just the income approach. And with it, the details look completely different. But these two approaches will give us exactly the same number for GDP apart from measurement errors. Now, of course, there are always going to be measurement errors, so they're not going to give us exactly the same number. But if we did not have any measurement errors, we would get exactly the same number for GDP using these two approaches. The reason is this: every time somebody spends money, somebody else is receiving money. And when you're receiving money, that's income. So when you have $1 of spending, it creates $1 of income. So you can calculate GDP by how much people spent, or you can calculate it by how much income was received. And here, GDP, or national income in this case, will equal wages plus rent plus interest plus profit. These are the income categories. These are the types of income that people receive. We can add up all the spending that was done. We can add up all of the income that was received. We're going to get the same number for GDP, apart from measurement errors. And I should point out also, there are a couple of adjustments when you use the income approach. There are a couple of additional adjustments that we have to make to finish out the income approach that have to do with certain types of taxes and depreciation. You'll be glad to know that we're not going to go into those adjustments. So for our purposes, you can use these two approaches and you would get the same number for GDP apart from measurement errors. Okay, and this kind of summarizes what we've already been saying. Y represents nominal GDP. I didn't call it nominal GDP before, but nominal simply means that we are measuring value in terms of prices that existed in the year we're talking about. So if we're talking about GDP for 2016, we're going to use 2016 prices. If we're looking at 2018, we're going to use 2018 prices. When we use the prices that existed in the year the output was produced, that is nominal that's a nominal measure of GDP for that year. You could also say that nominal GDP has not been adjusted for inflation. Inflation causes some big problems. Inflation causes some big problems when we're looking at GDP. And so eventually we will have to make some adjustments for inflation. But when we're just looking at nominal GDP, we don't have to worry about those yet. As I said, C stands for consumption, private sector spending on finished goods and services. I stands for investment spending. Roughly, this is private spending on tools, plant, and equipment used to produce future output. There are a couple of adjustments we have to make to that. We'll get to in just a minute. Government purchases, spending by all levels of government, okay, so it's federal, state, local, on finished goods and services. Why did I say it's not all government spending? Okay, well, because there's certain type of government spending that will not be included, and that is government transfer payments. Those, as we said before, those transfer payments like unemployment benefits, Social Security benefits, those are not included when we're calculating GDP. Okay? A lot of government spending is spending on those transfer payments, but they are not included when we're calculating GDP using the spending approach. And then finally, NX stands for net exports, which is the value of exports minus the value of imports. What's the difference between exports and imports? What are they?
Goods going out, goods coming in.
Exports are right there, goods going out. Imports are goods coming in. That's true, but I say there's a little bit, it's like a different way of saying that would be more helpful. Exports are goods that were produced here, but are purchased by somebody not in this country. Imports are goods that were produced where? Where were imports produced?
In other countries?
Somewhere else. They could have been produced anywhere except here. If they're U.S. imports, they were not produced here. Somebody else produced them, but they were purchased by somebody here. So exports, it's very important to have that clearly in your mind, because we're going to see that when we talk about foreign trade, exports and imports, there are some ways that it's really easy to get confused and to draw incorrect conclusions. And in fact, there's some things about foreign trade that even most very smart people don't get right. But if you think about it the right way, then it's really not that hard. Exports and imports, what are they? Exports were produced here. Imports were produced somewhere else. So why do we add the exports, but we don't add the imports? Why do we subtract the imports? Why is that necessary? What do you think? Well, go back to the definition of GDP. It's a total market value of all final goods and services produced within our nation's boundaries. So think about exports. A computer that is produced by Dell in the Austin area, Austin, Texas area. Okay? But let's say it's purchased by somebody in Mexico. Well, that computer, since it was produced in Texas, should be, the value of it should be included in US GDP. But if you go back and think about the spending approach, what is GDP? It's Y plus, or Y equals C plus I plus G plus NX. And if that computer had been purchased by an American household, then it would show up here. If it had been purchased by an American business, it would show up here. If it had been purchased by an American government, it would show up under G. But if it's purchased by somebody in Mexico or in any other country, it's not going to show up under C, I, or G. But since that computer was produced within the United States, it should be included in GDP. That's why we have to add exports in to calculate. Hold on just a second. That's why we have to add exports, because they should be included, but they don't get included in C, I, or G. Now, why do we have to subtract imports? The answer is not obvious. Say a car that was made in Japan and purchased by somebody in the United States. When I replace my poor minivan, I'm probably going to buy a Honda. Let's assume that that Honda is produced in Japan. So when I purchase that Honda, I'm an American citizen. I'm going to be spending money to purchase a product that was produced in another country. So as an American consumer, when I purchase that new minivan, that is going to be included in consumption, which means that is going to add to GDP, US GDP. But should it? That car produced by Honda in Japan should not be added, should not be included in US GDP, but it is included in consumption. So because the value of that Japanese produced car is included in consumption, but it shouldn't be included in US GDP, we have to subtract that out, because consumption is including something that should not be included in GDP. So my purchase of that Honda will be included in C, it'll be subtracted out in M, and so my purchase of that vehicle will not be included in GDP, and that's the way it should be. It's a little complicated, but that is the reason for it. We have to add exports because that's the only way we will include those US made goods that are purchased by somebody in another country. We have to subtract imports because that's the only way we can offset the fact that they were included under consumption. Okay? Any questions about that? It's a little confusing. Okay, here we have an interesting chart. It shows this is long-term average, 1950 to 2015. It shows that on average, consumption spending was 63.1% of GDP. So that's pretty close to 2/3, which the way to interpret that is roughly 2/3 of US output went to the household sector. Okay? Households got to use 2/3 of what was produced. Government, okay, 20.9%. Okay, means roughly 21% of what was produced in the U.S. Went to the government, was used by the government sector for various things. Investment spending, we said roughly that spending by the business sector to purchase new capital goods like new factories, new tools, new equipment. Investment also includes spending by households to purchase new residential housing. Now that's confusing because I said that consumption spending is spending by households, but there's an exception to that. When somebody purchases a new house, well, it's somebody in the household sector who is purchasing that house. So that's why I said that consumption is primarily spending by the household sector. Investment is primarily spending by the business sector. But there is this exception that households are the ones who purchase new houses, and that kind of spending is included under investment. And that was roughly 17% of what we produced that year. And then net exports, the difference between exports and imports, was negative, okay, minus 1.3%. Okay, well, the fact that this is negative, okay, what are the implications of that? Is that a good thing? Is that a bad thing? We're going to come back and touch on that in just a minute. We also need to talk about what happens when you have output that was produced during the year, but it didn't actually sell during the year. And let me give you a simple example. Let's say we're looking at a business, small business, that produces computers. And in 2020, they produce 1,000 computers. And these computers sell for, I'm sorry, hold on, I got my number wrong, just a second. I'm sorry, these computers sell for $1,000 a piece, okay? And let's say that they produce 500 computers during the year. So you got 500 computers, they sell for $1,000 a piece. So the total market value of that would be $500,000. They were produced during the year. So how much should that add to GDP? Got 500 computers. Each one is selling for $1,000. So, that's $500,000 worth of new computers. So that should add $500,000 to GDP. The question, though, is, or the problem is, if they don't all sell. Let's say only 400 of those computers sell during the year. How much of that $500,000 is going to show up in GDP? And it's a little bit complicated. So let's think about it like this. With our spending approach, we've got C, I, G, in X. And we said that GDP for the year is the total of those four types of spending. So we're only looking at this one firm and trying to figure out how much they will add to GDP. which category here will be affected by this spending? It's going to be C, I, G, or in X. Somebody take a shot at it.
Is it consumption?
It probably, it may be consumption. We're actually going to have to know a little more information. We're going to have to know who purchased these computers. If these computers were purchased by consumers, by a family, or an individual, then it would be consumption spending. And they're selling for $1,000 a piece. 400 of them sell. So that's $400,000 of consumption spending. So this is going to add $400,000 to consumption spending. And if we're adding 400 here, that means it's going to add $400,000 to bottom line GDP. Is that what should happen? We got 500 computers that were produced. How many of those should be included in GDP for the year? I saw someone's mouth move, but you're muted.
Is it the ones that were produced?
500?
That's right. All 500. Every computer that was produced this year should be included this year. So you've got 500 computers worth $1,000 a piece. GDP should go up by $500,000 because of the activity of this firm. But because only 400 of them were purchased, consumption is only 400,000. GDP goes up by only 400,000. The 100 computers that didn't sell need to be included, but are not included at this point. And so there's going to be some other adjustment. And this is a common problem. And so there is a rule for what to do in these situations. Think about these 100 computers. Or think about the firm overall. It produced 500. Think about it like this. When the firm produces something, they put it in their warehouse, their back room, their inventory. Okay? So they put 500 computers into their inventory. They sold 400 computers. So that means 400 came out of their inventory. So if you put 500 computers into the back room and then you take 400 out, that means at the end of the year, you have 100 more computers in the back room than you started with. In other words, your inventory has gone up by 100 computers. And since these computers are worth $1,000 a piece, that means this firm's inventories have gone up by $100,000. And the simple rule that is used to deal with this problem has to do with investment spending. When you have an increase in business inventories, that is counted as investment spending. Okay, it doesn't exactly follow from what we said about investment a minute ago. We said it's spending on new plant, new equipment, new machines, things like that. But this increase in business inventories is also counted as investment spending. So anytime you have output that was produced during the year, but it didn't sell during the year. That will be added to investment spending. So in calculating GDP for the year, the 100 computers that didn't sell will be counted as $100,000 of investment spending. And that means that all 500 computers will be included in GDP for 2020. And that's exactly as it should be, because we want to include the value of everything that was produced during the year. And we don't want to include anything that was not produced during the year. Okay. And this is a simple adjustment that is made to make sure that output that was produced but doesn't sell will be included. I would expect you'd get a question on that on the exam, because that's one of the basic things that you need to know about GDP, national income accounting. So look for a question like that. Any questions on that? All right. Does that raise any questions in your mind? Do you see any problem with that?
If one of the 100 computers is sold in a later year, how is that computed?
That's the question that you should be asking. Okay? That they're in the back room on December 31st. They've been counted in GDP for 2020, but presumably they're going to sell in 2021. What's going to happen? There's got to be a way to deal with that. And there is. For 2021, GDP is C plus I plus G plus NX. Let's say on January 1st, 2021, all 100 of these computers in inventory sell, and they all sell for $1,000. So that is $100,000 of spending. And let's say that these 100 computers are all purchased by a consumer, by a member of a household. That means that it is consumption spending that is occurring. So when these sell in 2020, that represents $100,000 of consumption spending. And if you add $100,000 to C, that also adds $100,000 to GDP. Is that okay? Does that look right? Or do you see a problem there?
It's been counted twice.
That's exactly right. Those 100 computers, well, every product that is produced in 1 year or another year. You can't have the same final good that was produced at 2 different times. So we've said that we want to include the value of a good in the year in which it was produced. And that was clearly in 2020. It was included here, so that was right. But now we're seeing in 2021, when these computers sell, it's adding to consumption spending, and therefore it's adding to GDP. We are double counting. So something has to be done to fix this, or we will be double counting, which will mean our numbers aren't representing what we intended for them to mean. So what rule could be used, or do we have a rule that would enable us to avoid this double counting? Think about what we did here. We said when we have a change in business inventories, we count that as investment spending. And in 2020, inventories went up by 100 computers, which means there was $100,000 of investment spending.
Would
in
you deduct
2020.
inventory then?
That's exactly right. We're going to deduct it. We're going to subtract it from investment, because in 2021, when we take these 100 computers out of the back room and we sell them, our inventories go down. And so that is negative investment. So we will have a minus 100,000 here, which means a minus 100,000 down here. Okay. So in 2021, these 100 computers that were produced in the previous year, but they sell in this year, okay, those will show up in the accounts, the GDP accounts, but they do not add to GDP. We had to include them under consumption. We had to include them under investment, but the two entries cancel each other out so that the net effect on GDP is zero. And that's exactly the way it should be. Every computer produced in 2020 adds to GDP in 2020, and no computer in 2021 is included unless it was produced in 2021. The rule is very logical. It makes sense. If you have the data, it's not hard to enter that data correctly and get the right numbers for GDP. However, recognize when you're talking about millions of businesses and millions of different products, okay, there are going to be errors in measuring what happened exactly. So is this going to lead to some measurement error? You can bet on it. Okay, GDP numbers are not going to be precise. There's going to be error in it, but we can say that the rules are consistent. The rules make sense. If the rules are applied, then we will include only the value of what was produced in each year. Okay. All right, now let's go back and talk about exports and imports. In 2015, we imported $2.8 trillion worth of goods and services. Okay, so think about what that is. Anytime you hear a number or you read a number, think about what does that represent? Because if these are things you don't think about every day, and for normal people, they don't think about imports and exports every day. So you'll need to remind yourself as you go through these things what they represent. Imports are things that were produced somewhere else but purchased by people in this country. So that means that we purchased $2.8 trillion worth of output that was produced elsewhere. Exports, 2.3 million. That means there's $2.3 trillion worth of output that was produced in this country, but it was purchased by somebody in another country. We've already said we're going to add the exports. We're going to subtract the imports. And you can see here, 2.8 trillion is greater than 2.3 trillion. Our imports are greater than our exports. We are buying more from other countries than we are selling to other countries. And if our imports are greater than our exports, that means NX, net exports, will be negative. In this case, minus $0.5 trillion, okay? Meaning $500 billion worth of output. Okay? We bought that much more from other countries than they bought from us. The arithmetic there is very simple. You're just subtracting. When net exports are negative, this is called a trade deficit. Okay? The arithmetic is very simple, but what does it mean? What does it represent? Is having a trade deficit a good thing, or is it a bad thing? And I would bet that if I did a poll, then 95% of people would say, obviously it's a bad thing. I mean, we call it a trade deficit. When's the last time you heard of a deficit that was a good thing? If I called your name at the beginning of class and said, I need to talk to you about your deficit, you would probably not think, oh, this is probably good. You would think, uh-oh, what did I do wrong? And so the fact that we call it a deficit plants in your mind the idea this is not a good thing. And certainly most politicians, many economists will talk about a trade deficit as being a bad thing. And keep in mind that we are we said we add net exports, and remember net exports are exports minus imports. So when we have a trade deficit, that means that this last term is negative. And if you subtract something from a negative, or if you subtract a number here, it looks like that's going to reduce GDP. So it's very easy to see how you could conclude, well, a trade deficit is a bad thing, because that means this term is negative, and if you hold all these others constant, that means that GDP will be negative. Right? Here, this is there's a number of points in economics where the intuitive conclusion isn't correct. And this is just one of those points. And we won't go into this in great detail, but let me just point out one thing. If we look at C, I, and G, okay, we said as a percentage of national output, that was 68%, 17%, 18%. And we said that this means that roughly 68% of what we produced in the year was used by American consumers, and 17% was used by American businesses, and 18% was used by American governments. So if we add these three numbers together, that's going to give us the fraction of US output that was used by American consumers, businesses, and governments. And when we add those three numbers together, we get 103%. Think about what that means. It means that in that year, American households, businesses, and governments were able to use 103% of what we produced. In other words, Americans collectively, households, businesses, and governments were able to use more output than they produced. Well, that seems like that is a good thing. Okay? How did that happen? Well, that can happen only because we were running a foreign trade deficit. Okay? Now, this doesn't prove that a trade deficit is a good thing, but it does show you that a trade deficit is not inherently a bad thing. Okay? In this one sense, at least, a trade deficit does have a certain benefit for us in the present. Okay? Now, we haven't looked at the full impact of having a trade deficit, but I would suggest to you two things to remember. One, a trade deficit isn't inherently a bad thing. Okay? Many people think it is. That's not true. Okay? And rather than worrying about the trade deficit and whether, or the trade balance, whether it's positive or negative, it's better to think in terms of, well, why did we have that result? Okay. Well, we had a deficit simply because as individuals, as businesses were making decisions, they ended up in total buying more stuff from other countries than other countries ended up buying in total from us. The fact that exports were less than imports isn't a problem in and of itself. If I decide to buy a Japanese car because I look at all the options open to me and I decide this car that Honda is offering me at this particular price is a good deal for me, then I should buy it. I don't need to worry about, oh, well, what's this going to do to the trade deficit? Okay? No, I should use my resources in the way that seems best. And if it seems to me that buying that Honda from a Japanese company at the price they're charging is going to benefit me, then I should do it. And that's what you should do. That's what we should all do. We should use the resources that we have in a way that seems most efficient to us. And if it turns out that we have a trade deficit, that's not really something that is important. If it turns out we have a trade surplus, okay, that's not necessarily a good thing. What is important is that in each transaction that we engage in, we look at the facts available to us and we use our resources in the way that seems to be most efficient. And we don't need the government to say, well, you think that it's better for you to buy a Honda, but that's going to cause a trade deficit, so we're not going to let you do that. Okay, the net exports is a factor in understanding GDP, but we don't need to change our behavior based on whether that trade balance is positive or negative. Okay, we'll talk more about the trade balance late in a later chapter, I believe, chapter 29.
I have a question.
Okay.
Are trade deficits kind of the norm?
Well, having a trade deficit has been what we have experienced in the United States for decades. That is what we have experienced. So it is the norm in the sense of this has generally happened. Okay, it would not be the norm for all countries, because if you have some countries that are running a trade deficit, you're going to have other countries that are running a trade surplus. And a deficit, a surplus, neither one is inherently good, neither one is inherently bad. Now, when you are running a trade, think about it like this. When you're running a trade deficit, okay, that means you're buying more from other countries than they're buying from you. That means we're getting more stuff from other countries. We're getting more cars or computers or whatever. We're getting more stuff from them than we're sending to them. So in one sense, it's clear that we do benefit in a certain sense, because we're getting more stuff from them than we're having to send to them. Okay. And there are going to be other countries who are in the opposite situation. When we're getting more stuff from them than they're getting from us, that means we're sending them more dollars, more money than than they're sending to us. Okay. The people who, largely politicians, who are assuming that a trade deficit is a bad thing, they are really focusing on money, because when you have a trade deficit, that does mean that on these exports and import accounts, dollars are flowing out of the country. That is the sense in which it is a deficit. Dollars are flowing out. So the people who think that a trade deficit is inherently a bad thing are focusing on money. Okay? And if you recall, that's pretty much the problem that the mercantilists had. They thought that for a country to be wealthy, then you had to make sure money, gold and silver, came into the country, and you had to try to prevent gold and silver from leaving. So the people who think that a trade deficit is inherently bad, it's really because they see dollars flowing out and they think, oh, that's a bad thing. Since Adam Smith, there's been an understanding, no, that's not the right way to look at it. Just like when I go to Walmart. Okay? If you think of my family as being one country, think of Walmart as being another country, and Walmart's big enough to almost be a country. I have a huge trade deficit with Walmart. I buy so much stuff from them, clearly thousands of dollars of stuff I buy from Walmart. I'm getting all of this stuff. I'm sending them lots and lots of money. Okay? And Walmart never comes to me and says, we want to buy some economic lectures from you. They don't buy anything from me. Okay? I buy from them. They don't buy from me. I have a huge trade deficit with Walmart. Do you think I would be better off if I said, I'm not going to put up with this anymore? I am not going to buy from Walmart anymore. Okay? I can guarantee you, if I did that, it would lower my standard of living. I would be much worse off. I have a trade deficit with them. That's really irrelevant. Okay? And when we have a trade deficit, especially with a particular country, that's not necessarily a bad thing. Okay? The question is, why do we have it? Are people engaging in trades which make them better off? And if they are, then the fact that there's a deficit isn't going to be, isn't going to be a problem. Okay. We will come back and talk more about this later. Only other thing I will say here is that when we're looking at exports and imports, that's not the whole story of trade. Okay, there is also something called the capital account, where that records transactions where people in this country are purchasing assets from another country, and where people in other countries are purchasing assets in this country. Okay? Those are very important transactions as well. With the current account, which is what net exports is telling us about, that's just dealing with goods and services that were produced this period. It turns out that if we have a deficit in our current account, we're going to have a surplus in the capital account. So just keep in mind that what we're looking at here is not the whole story on our trade with other countries. It's just one part of it. And we will come back later and talk about that other part. Okay. All of that has been dealing with the spending approach to calculating GDP. The other approach we're not going to spend quite as much time on is called the factor income approach. We said every time a dollar is spent, that's going to generate income for someone. And the equation to represent the income approach is here. Okay? With the income approach, we're trying to identify all of the income that was generated during the year. And so it's like we're looking at a coin that has two sides. On one side, you have spending. On the other side, you have income. Every time spending is done, income is generated. With the spending approach, we're looking at the side that calculates spending. With the income approach, we're looking at the side that calculates income. So we're two different ways of looking at the same economic activity. And here we identify 4 different types of income that is generated. Employee compensation. Well, you're an employee if you are working for someone else. So the compensation that you get for working for your employer, that's what we're including here. So that would be the salary you get, the value of the benefits you receive, all of those things you're receiving from your employer, that counts as employee compensation. Rent, okay, well, that would be when you think about if you're renting an apartment, okay, you're living in this apartment. It doesn't mean you own the apartment. Okay? It's still owned by the landlord, but you are getting to use it for a period of time. Rent is the payment that is made to the owner of a property when they let somebody else use that property for a period of time. So it doesn't just apply to apartments, it applies to any asset where the owner says, excuse me, applies to any asset where the owner says, for some period of time, pay me this money, I'll let you use my asset. So that can be apartments, it can be equipment, it can be whole factories in some cases. Okay, so that's the compensation going to the owners of resources who let somebody else use their property for a period of time. Interest is the compensation that lenders get. Okay? Think about, what does a lender do? You go to the bank, and the bank, you borrow money for a year, let's say, you're going to pay interest. And the interest is the compensation the bank is getting for allowing you to use that money for a period of time. You have to give it back, okay? You have to give the money back, and you have to pay interest as compensation to the lender for letting you use that money for a period of time. Okay, so again, that's compensation. All of these are compensation. Compensation going to the employees, compensation going to resource owners, compensation going to lenders, and then profit. Profit is compensation. It's the compensation going to, if you're talking about a sole proprietorship or a partnership, then it would be the compensation going to the owners of those businesses. What are they being compensated for? Well, you start a business, you're investing your own money in it. Okay, and so it's compensation they're getting for investing their money in the business. If you start a new business and you have to invest $200,000 in it, well, there are a lot of things you could have done with that $200,000. By starting the business, you're giving up those other things you could have had. Okay? Why should you do that? Well, profit is hold on just a second. When you invest or you start your own business, then you're giving up those other things you could have had. Profit is the compensation you're getting for giving those things up. Also, profit is compensation for the risk that you're bearing. You may start a business and invest $200,000, and at the end of the year or at the end of 5 years, it may be worth nothing. Okay? Over half of new businesses that start will not be around 5 years from now. They won't survive. So you're bearing a lot of risk when you when you start a business. Most people don't like risk. And so if we want people to start businesses and bear that risk, they have to receive compensation. That's really important to remember when we think about profit. Let's see. Okay, and just give you one example of how these two approaches fit together. Let's say that you spend $1 to buy a peach. Okay, very simple transaction. How is GDP going to be affected according to the two approaches? Well, with the expenditure approach or spending approach, y equals c plus I plus g plus nx. The effect is very simple. You are a consumer. If you spend $1 on a peach, that adds $1 to consumption spending, which means that adds $1 to GDP. That's it. That's it. Okay. Now, with the income approach, how will GDP be affected? Okay. Well, you are spending $1. By spending $1, we mean you're going to the store, he's giving you peaches, you're giving him $1. Okay? And you're giving up your money. Okay? You now have a trade deficit with this grocer. Okay? But that doesn't mean that you're being exploited. Okay? You're getting a peach that to you is worth more than $1. Okay? If it wasn't worth more than $1, you would not have purchased it. Okay, so you're giving your dollar voluntarily to the grocer. The grocer receives it as income. Okay, so that is $1 of income. Now, if the grocer doesn't have any costs, obviously in the real world firms do have costs. If the grocer does not have any cost, then the full $1 will be income for him. That would be $1 of profit. But obviously the grocer is going to have some cost. For example, grocery stores hire workers and they have to pay wages to their workers. Let's say that 30 cents of your dollar is going to be used to pay wages to the workers. Let's say the grocer has borrowed some money and he's going to have to pay interest on this loan. Let's say that 20 cents of your dollar is going to be used to pay the interest. Let's say also he's rented some equipment. And we'll say that he's going to use 20 cents of your dollar to pay rent. And now let's make an assumption just to simplify that these are the only 3 costs that he has. Okay. If that's the case, how much income was generated in the economy from your spending that $1? We know that it added $1 to GDP according to the spending approach, but from the income approach, how much income was generated? Think about that for a second.
Is it 30 cents?
30 cents. If we calculate the profit, what is profit? Profit is the difference between the firm's total revenue and its total cost. So because of your purchase of this peach, that gave the grocer $1 in revenue. He has 70 cents of cost. So because you spent the dollar, that generates 30 cents of profit for this grocer. And that represents 30 cents of income in the economy. So how much income was generated in the economy because of your spending a dollar? It's not 30 cents. That's the obvious answer, but that's not the whole story. When you spend that dollar, it does generate 30 cents of profit for the grocer, but it also generates 30 cents of wage income and 30 cents or 20 cents of interest income and 20 cents of rental income. Okay. And if you add 30 plus 20 plus 20 plus 30, you find that the total income generated is $1. Okay. Because you spent a dollar worth of income was generated in the economy. That's how things generally work. Okay, there are a couple of things that are make the world more complicated, like certain kinds of taxes. We're not going to get into those things. All I want you to recognize that when a dollar is spent, that's going to generate a dollar of income. And as a result of that, we can calculate GDP by looking at spending, or we can calculate it by looking at income. And apart from measurement errors, we're going to get exactly the same number. And that's why the government collects lots of data on spending and on income, because they're attempts to measure the same thing, but they do give us different perspectives on what is going on in the economy. All right, we are out of time. I didn't call the roll at the beginning of class since everybody is Zooming, so I will be using the Zoom participant list to give you credit for being here. So you will get recorded as present. Any questions?
I have one.
Okay.
Whatever the amount of income that's spent, that's always the total income?
I lost your connection there for a second. I think you said whatever the total amount of spending is will equal the total income. Yes, apart from measurement errors and apart from these complications that we're not going to go into. So for our purposes, they'll be the same thing.
Okay, thank you.
Okay, next time we will, or a few more things to say about chapter 26. We'll finish it up pretty quickly. Then we will go into chapter 28. We're not going to spend a lot of time on 28. If you read the chapter, it gets into quite a bit of technical detail, more than I'm going to require you to know. So for 28, you need to watch the videos. Those are important because I think they will introduce you to some important concepts. Watch the videos. Any questions on the exam from chapter 28 will come directly from the MRU video questions. Okay, so you don't have to understand everything in chapter 28. You want to have a general understanding of the things that are covered in the videos, and then especially of the part of 28 that I will cover in class. I will cover the things that you need to know from 28 in class, and I'll be looking for an understanding of the big ideas there and not all the details, because some chapters they go into a lot more detail than I think is worth going into. So we'll finish 26, and we'll go into 28, hopefully finish 28 next time. All right, my expectation is that we will be back to our regular format on Tuesday, where half of you will be in class on campus. But check your email, because I don't know for sure if that's the case. So I'll let you know when I do. Have a good day.
All right, you too.
Bye-bye.
Bye.